What if I told you in the next financial crisis, most banks won't survive, but a few already know they will? Because behind the scenes, there are only a handful of institutions built so strong, so deeply rooted in the system, that failure isn't even part of the equation. Let's be real for a second. Every decade, the world changes, markets crash, economies reset, panic spreads, and yet some banks don't just survive, they come out stronger. Why? It's not luck, it's structure. If you want to understand how money really moves and which institutions actually control the game, hit subscribe right now, because what's coming next will change how you see the financial system forever. The idea of too big to fail is rooted in the reality that certain financial institutions have grown so large, interconnected, and essential to the functioning of the global economy that their collapse would trigger widespread damage far beyond their own balance sheets. These banks are deeply embedded in payment systems, corporate financing, global trade, and even government debt markets. If one of them were to suddenly fail, it could freeze credit, disrupt liquidity, and create panic across markets worldwide. Because of this, regulators and governments view their survival as critical to maintaining economic stability. Over time, these institutions have been officially classified as systemically important, meaning they are subject to stricter regulations, higher capital requirements, and constant monitoring. However, this designation also creates an implicit safety net, as markets believe that governments will step in to prevent their failure during extreme crises. This expectation influences investor confidence, allowing these banks to borrow at lower costs and maintain stronger positions during downturns. Their size also allows them to diversify operations across multiple sectors and regions, reducing vulnerability to isolated shocks. While smaller banks may struggle with localized economic stress, these large institutions can offset losses with gains elsewhere. Additionally, their access to central bank liquidity facilities ensures they can maintain operations even during severe financial stress, reinforcing the perception that they are not just banks, but pillars of the financial system itself. Strong capital reserves and liquidity buffers are the foundation of a bank's ability to survive financial stress, absorb losses, and maintain confidence during periods of uncertainty. Capital represents the bank's own financial cushion, primarily made up of shareholder equity and retained earnings, which can be used to absorb unexpected losses without immediately threatening the institution's stability. Regulators require large banks to maintain high capital ratios, ensuring they have enough internal strength to withstand shocks such as loan defaults, market downturns, or sudden asset devaluations. The higher the capital base, the greater the bank's ability to continue operating, even when facing significant financial pressure. Liquidity, on the other hand, refers to a bank's ability to meet short-term obligations, especially customer withdrawals and funding needs. Even a profitable bank can collapse if it runs out of cash in the short term, which is why liquidity buffers are critical. These buffers include highly liquid assets such as cash, central bank reserves, and government securities that can be quickly converted into cash without significant loss in value. During times of crisis, when panic can lead to mass withdrawals or frozen credit markets, these liquid assets act as a lifeline, allowing banks to continue functioning smoothly. Modern banking regulations emphasize stress testing to ensure institutions can handle extreme scenarios, including economic recessions or market crashes. Banks simulate worst-case conditions to evaluate whether their capital and liquidity positions are strong enough to endure prolonged stress, ensuring resilience and operational continuity even under severe financial strain. Diversification across sectors, asset classes, and geographic regions is one of the most powerful ways a bank protects itself from instability and unexpected losses. Instead of relying on a single source of income or a narrow segment of the economy, large institutions spread their exposure across multiple business lines such as retail banking, corporate lending, investment banking, asset management, and trading operations. This structure ensures that when one area underperforms due to economic downturns or market volatility, other divisions can continue generating revenue and offset those losses. For example, a slowdown in consumer lending might be balanced by stronger performance in wealth management or capital markets activity. Geographic diversification adds another layer of protection by reducing dependence on any single country or economy. If one region experiences recession, political instability, or regulatory changes, banks with a global presence can rely on more stable or growing markets elsewhere. This ability to shift focus and maintain operations across borders provides a level of resilience that smaller, regionally concentrated banks often lack. Diversification also extends to the types of assets held on a bank's balance sheet. By holding a mix of loans, securities, and other financial instruments with varying risk profiles, banks reduce the likelihood that a single event will significantly damage their overall financial position. This balanced approach helps stabilize earnings over time and minimizes exposure to sudden shocks. It allows institutions to remain operational and profitable even when specific industries or markets face severe disruptions. Government backing and systemic importance play a critical role in determining whether a bank can withstand extreme financial stress without collapsing. Certain institutions are designated as systemically important because their size, complexity, and interconnectedness make them essential to the stability of the financial system. These banks are deeply integrated into payment networks, credit markets, and global financial flows, meaning their failure would create ripple effects across economies, businesses, and households. Because of this, governments and regulators prioritize their stability above all else, implementing strict oversight and regulatory frameworks to reduce the risk of failure. This designation often comes with an implicit guarantee that in times of severe crisis, authorities will step in to prevent collapse. While not always openly stated, markets widely believe that these institutions will receive support through measures such as emergency funding, liquidity injections, or structured bailouts if necessary. This expectation strengthens confidence among investors, depositors, and counterparties, reducing the likelihood of panic-driven withdrawals or sudden loss of funding. In addition, systemically important banks are required to maintain higher capital buffers, undergo regular stress testing, and follow stringent risk management standards. These requirements are designed to ensure they can absorb shocks independently before any external support becomes necessary. Their close relationship with central banks also provides access to emergency liquidity facilities during times of market disruption, reinforcing their ability to continue operating under pressure. This combination of regulatory protection, market confidence, and potential government intervention creates a powerful safety net that significantly lowers the probability of failure. Risk management culture is what separates institutions that survive decades of uncertainty from those that collapse under pressure because it shapes how decisions are made at every level of the organization. It is not just about policies or models, but about mindset, discipline, and consistency in how risks are identified, measured, and controlled. In strong institutions, risk management is embedded into daily operations, influencing lending standards, investment strategies, and capital allocation. Leaders prioritize long-term stability over short-term gains, even when it means walking away from highly profitable opportunities that carry hidden or excessive risk. This culture ensures that employees across all departments understand the importance of balancing growth with caution. Instead of chasing aggressive expansion, these banks focus on maintaining underwriting quality, monitoring exposure limits, and continuously reassessing market conditions. They invest heavily in data analytics, stress testing, and scenario planning to anticipate potential threats before they escalate. By doing so, they reduce the likelihood of being caught off guard by sudden economic shifts or market disruptions. A strong risk culture also encourages transparency and accountability. Problems are identified early, communicated openly, and addressed without delay, rather than being ignored or hidden to protect short-term performance metrics. This approach prevents small issues from turning into systemic failures. Over time, this disciplined framework builds resilience, allowing institutions to absorb shocks, maintain investor confidence, and continue operating effectively even during periods of extreme financial stress. Global presence allows large banks to operate across multiple economies, currencies, and regulatory environments, which significantly reduces their exposure to localized economic shocks. Instead of being dependent on the performance of a single country, these institutions generate revenue from a wide range of regions, including developed and emerging markets. When one economy slows down due to recession, inflation, or political instability, operations in other regions can continue to perform well, creating a natural hedge against downturns. This geographic spread stabilizes earnings and ensures that losses in one market do not immediately threaten the entire institution. Operating globally also provides access to diverse funding sources and customer bases. Banks can attract deposits, investments, and business clients from different parts of the world, reducing reliance on any single group. This flexibility becomes especially important during times of financial stress when funding conditions may tighten in one region but remain stable in another. It allows banks to shift capital and liquidity where it is most needed, maintaining operational continuity even under pressure. In addition, a global footprint enables banks to participate in international trade, cross-border financing, and currency markets, which are less sensitive to localized disruptions. These activities generate consistent income streams and strengthen the bank's role in the global financial system. Being deeply integrated into international markets also increases their importance to economic stability, making them more likely to receive regulatory support if systemic risks arise. Access to central bank support is one of the most powerful yet often overlooked advantages that large financial institutions possess, especially during periods of extreme market stress. Central banks act as lenders of last resort, providing emergency liquidity to banks that are fundamentally solvent but facing short-term funding shortages. This support can take the form of direct lending facilities, repurchase agreements, or discount window borrowing, all designed to ensure that banks can continue meeting their obligations even when normal funding channels freeze. In times of crisis, financial markets can become highly unstable, and institutions may struggle to access cash despite having strong balance sheets. This is where central bank access becomes critical, as it allows banks to convert high-quality assets into immediate liquidity without being forced to sell them at distressed prices. By doing so, banks avoid realizing unnecessary losses and maintain confidence among investors and depositors. Larger, systemically important banks typically have more direct and reliable access to these facilities due to their regulatory status and close oversight relationships with central authorities. They are also required to hold eligible collateral, such as government securities, which can be used to secure emergency funding quickly. This readiness ensures that when liquidity pressures arise, they can respond immediately without disrupting operations. The presence of this backstop reduces the likelihood of bank runs and stabilizes the broader financial system, as it reassures markets that major institutions will have the resources needed to navigate temporary disruptions without collapsing under pressure. Trust and the stability of customer deposits form the core foundation of any bank's survival, especially during times of financial uncertainty. Unlike other businesses, banks rely heavily on the confidence of their depositors because a large portion of their funding comes from individuals and institutions placing their money with them. When customers believe their funds are safe, deposits remain stable, allowing the bank to operate smoothly, lend money, and manage its obligations effectively. However, if that trust is shaken, even a financially sound bank can face serious trouble as depositors rush to withdraw their funds, creating a liquidity crisis. Stable deposits are considered one of the most reliable and cost-effective sources of funding for banks. Retail deposits in particular tend to be less volatile than institutional or wholesale funding, as individual customers are less likely to react quickly to market fluctuations. Large, well-established banks often benefit from strong brand recognition and long-standing relationships, which reinforce depositor confidence and reduce the risk of sudden withdrawals. Trust is built over time through consistent performance, transparent communication, and a reputation for safety and reliability. Banks that prioritize customer relationships and maintain a history of stability are more likely to retain deposits even during periods of market stress. Additionally, deposit insurance systems and regulatory oversight further strengthen confidence, reassuring customers that their money is protected up to certain limits. This combination of trust, stability, and institutional credibility ensures that deposits remain intact, providing the liquidity needed to withstand financial shocks and continue operations without disruption. At the end of the day, the difference between banks that collapse and those that endure isn't luck, timing, or even size alone. It's how they are built, how they manage risk, and how deeply they are woven into the financial system. The institutions that stand the test of every crisis are the ones with strong capital, deep liquidity, global reach, disciplined risk culture, and the trust of millions who rely on them. They don't just react to crises, they prepare for them long before they arrive. When uncertainty rises and fear spreads, weaker institutions struggle to survive, but the strongest use those same moments to reinforce their dominance and expand their influence. They are supported by structure, protected by regulation, and strengthened by confidence. That is why when the next financial storm hits, and it will, the outcome is rarely a surprise. The same names remain, the same institutions stand tall, and the system once again consolidates around those built not just to grow, but to last.